Hello and welcome to the TradeFloor option game trading recap, where we will discuss how the winners of the game return more than 400% in just 8 weeks of trading. Well, let's begin. My name is Ivan Shrilov and I'm the co-founder and managing director of TradeFloor. TradeFloor builds and operates the options trading game, which is the first and only options game in the world. TradeFloor has also built the market-leading derivatives risk management product in Australia, and approximately 60% of retail options volume is managed through our systems. We've got some of the largest derivatives desks as our clients, and if anybody here is looking for a full-service stockbroker, please let me know. I can put you in touch with some of the largest and most successful options traders out there. Okay, today we're going to talk about how the winners of the game returned over 400% in just 8 weeks of trading. And at the end, I will show you a simple option strategy that everyone who trades or invests in shares should start implementing today. It's so effective, it's used by the largest hedge funds in the world every day as part of their equity portfolios to boost their returns. You can do this through any broker that allows options trading, and as long as you don't break the rules, it's risk-free. At the end of this, we will also do a question and answer time. So as we go through, write down your questions and only I will see them and read them out at the end of the day. Let's begin with a disclaimer. Just so you're aware, there's no trading advice given in this presentation. If during Q&A there will be some trading advice, it's very general. It does not take into consideration your objectives, financial situations. I do not know your needs. Before acting on anything, please consider how appropriate it is for you in regard to your objectives, financial situation and needs. Options do carry risk. Certain situations, certain strategies, you can actually lose significantly more than you've put down as you deposit. So please ensure you understand the impact of leverage. Okay, well, let's begin with the leaderboard. Now, generally, despite very difficult trading conditions for options traders in particular, with very low volatility and low amount of movement in the stock market in Australia, we've had some standout results. Andrew and Roman in particular, who we'll concentrate on, Andrew returned over 400%, finishing up a touch over 256,000 on his portfolio. Roman returned over 250%, and finished up with his final portfolio being over 175,000. So both very good results. In particular, we will look at not only the winning trades, but also the losing trades of some of these traders. Well, let's begin with Andrew, and he starts out really nice and simple. He's a beginning options trader, and what he did is he put on long calls on Wesfarmers and BlueScope. Now, these are pretty straightforward strategies. You effectively buy an at-the-money call by default, and you expect that the price is going to go up. With a long call, you are very, very bullish on a certain stock for whatever reason or asset class, and you're not concerned about the impact of time decay. So you really run this when you are 100% sure that the market is going to go up. The best thing about the strategy is if the market tends to prove you completely wrong, you are only going to lose your initial premium. The more bullish you are, the further out of the money you pick your strike. That way you get more leverage. Long calls are a very good beginner strategy because the maximum profit is unlimited and the maximum loss is limited to the premium that you've paid. Now, we've traditionally seen long calls and long puts win the games in the past. Why? Well, they allow you a large amount of leverage and they're one of the simplest strategies that you can put on. Longer term traders, however, will know that they're good in certain scenarios. However, they're not the key to long-term success. Okay, let's have a look at the actual trades. The first trade that he put on was he bought 500 Wesfarmers. December was the front month when he put this trade on. He bought an at the money, he paid 26,000. This gave him control over $2.1 million worth of stock. The other trade that he put on, he bought 800 BlueScope December 17 calls at the money as well, which was similar. And he paid $36,000 for this trade, and this gave him control of over $1 million worth of stock. Let's have a look at Wesfarmers first, and this is what it did from the middle of June until the start of the game. And what Andrew identified were higher lows, and he bought as he saw the stock bouncing off the red line. In all of the charts, the thin red line is the 50-day simple moving average, and the thin blue line is the 200-day simple moving average. We also have the implied volatility indicator, which is our chart of the at-the-money implied volatility, and the MACD indicator down the bottom. Now, the interesting thing here is, for those of you who are technically inclined, you will have noticed that the stock has actually done an ascending wedge, which is meant to be a bearish signal. The stock is making consecutively higher lows, however the highs are getting less and less strong. It's bearish due to the angle of the ascent of the upper trend line, which is that dark red line, which implies that the bulls are not able to push prices high enough to maintain a complete rising trend channel. This, in this case, held true right up until the moment that it broke out. And then, as soon as that happened, it started serving as support. What Andrew did is, as he saw this go higher and higher, he identified that it's coming up to the end of the game and he's probably happy with where the stock's moved, so he's closed it down and he made over $50,000 on this trade. Let's have a look at BlueScope. BlueScope was in a quite different scenario. It started out as a stock all over the place, trading from sub 11 to almost $15. And on the back of the 50-day moving average crossing over the 200-day moving average, that's the red going higher than the blue, and BSL posting the highest price since its big drop in August, Andrew bought $36,000 worth of long calls. The stock generally went nowhere until it had a big announcement almost a month later, and the stock rose significantly, giving Andrew the perfect opportunity to sell and profit a touch over $50,000. Okay, well, let's get into something a little bit more interesting. This is a Tabcorp leveraged synthetic long, and this is a bit of a modified strategy. So what he's done is he started by putting on a long call, and he's also added a synthetic long stock. A synthetic long stock is something that allows you to simulate the payoff of a share, but with much less capital outlay. So it gives you a leveraged position. The opposite to a synthetic long is a synthetic short stock, which simulates a payoff of short selling a share where you can profit from a falling market. So for those of you that are thinking that certain stocks in the top 70 are overextending or overheating, you can use this strategy to profit from the stock going down. To look at the risk reward of these two trades together, let's start by bringing up the risk reward of a long call. Now, adding the long stock to this trade pushes the maximum loss up. However, you're paying less for this trade, so you can leverage this trade a lot more. So now that the maximum risk is the strike price. What this means is that, very similar to a stock, if you go in and buy a stock at $20 and the company goes bankrupt, you will lose $20 on the stock times the amount of units that you hold. This maximum loss is exactly the same as a share. So let's have a look as to how he's put it on. So he sells 500 November 17 puts at the money, and he buys 500 calls with the same strike. This costs him $500 in premium, and then he pays about $15,000 in margin. This gives him control of $225,000 worth of stock, so roughly 15 to 1 leverage. However, what he decided for extra leverage is he bought another 3,000 November 17 calls at the money, and he paid $28,000 for this, and this gave him control of another $1.3 million. So overall, he's got approximately $1.6 million worth of stock that he's now in control of. Let's have a look at the chart. And so Tabcorp's been really range bound, and it's been trading between $4 and $4.50 for almost half a year. And what Andrew decided was that he was looking at a early November breakout. He buys and he pays $29,000 to get this trade on the 4th or the 5th of November, and pushes up higher. A big announcement comes out and the stock goes to $5, giving him a perfect opportunity to sell and profit $130,000. Now, the interesting thing with this trade is that, unlike his perfect timing in the other trades, although this timing was very good, if he actually held on till the end of the game, he would have more than doubled his return. The stock went well past $5.50 towards the end of December. With a $50,000 share portfolio, if he put on the same trades, the best case return he would have made is $10,000. With options, he made over $200,000. And this is a great example of how options allow you leverage. If you're trading properly, they will also reduce the amount of risk that you're doing. So if you look at the long call, for example, that he did, the maximum loss if he got it completely wrong would be the amount of premium that he's paid. Options, as we've discussed, also allow you short selling, and they allow you the ability to profit in any market. The market's been trading in a very tight range, and options have given you the opportunity to boost your returns. And for those that are using it carefully with covered calls and cash secured puts, the options market has given them the ability to generate more profit. Okay, well, let's have a look at Roman's trades. And what Roman decided to do is go the complete other end of the spectrum and do short strangles. Now, short strangle means that you're selling an out of the money call and you're selling an out of the money put. What you're assuming is that the market isn't going to go outside between your call strike and your put strike. So you think this is the range that it's going to stay in. Now, the other time that you use this is, let's say an earnings event comes out and volatility spikes, and what you think is the market is going to, or the asset is going to consolidate. And so you can put a strangle on it and you assume that it is not going to have these erratic movements as it did because of some unexpected earnings report or announcement. What you're doing with this trade is you're effectively making the bet that something in the market won't happen. If it doesn't happen, you keep all the premium. So it's like an insurance company issuing insurance policies. The risk reward is where it gets tricky. So the maximum you will ever receive from this trade is the premium. The maximum loss, however, is theoretically unlimited. So if you put on a short strangle on a stock that's worth $20 and the stock doubles, you are going to lose a lot more than the amount of premium that you've received on that trade. This is very important, then that begs the question, why do people put this trade on? Well, it goes back to being the complete opposite of what the long call is. The probability of profit on this trade is much greater than on the long call. However, the amount that you'll profit is going to be a lot less. Options have time decay, and time decay is something that we will discuss in some of the following webinars in a fair bit of detail, because it's very important you understand the impact of time decay and how it benefits your portfolio. Okay, well, let's have a look at the specific trades. And so what he's done is he sold 500 out of the money calls and out of the money puts, as we've discussed. He's received $18,000 in premium for the trade. However, he had to pay margin to keep it going. This gave him control of approximately $2 million worth of stock, although it's not really that applicable as a measure in this case. Okay, so this is what Sims Metals has been doing. Again, it's been in that 13 to 16 range. It's been quite tightly kept there. And what Roman thought was that it's going to stay between 1389 and 1265. So his sweet spot is this light blue box. The other thing to notice is that volatility moved from sub 30 to around about 35. So that's quite a big increase. This strategy would benefit if volatility returned back and the stock price consolidated in that range. However, the price started moving and it actually started pushing against the 50-day moving average. And as it did this, Roman decided to roll his call position. There would have probably also been a margin call at this stage where he had to manage and maintain his margin. So he took a $14,000 loss on his initial sold call. To make up for that premium change, he sold double the amount of calls out of the money at a higher strike. So this 1389 now became a 1439. So his payoff has changed dramatically, and he needs a stock price to stay underneath 1439. Now that the market's pushed up again, he's probably had another margin call to deal with, and he decided to buy back 500 of his puts. He made $5,000 profit on that trade, and he doesn't now have the risk there. As a result, he's now just got a naked sold call position. The market had a bit of a move around, and around about in this candle, what Roman did is he actually closed that call and put it back on later in the day, and that gave him a slightly better entry on that initial call. The market settled at 14.29, so just 10 cents under his strike. He received around about $5,000 for his 1265 puts that he bought back before, as we've mentioned, and his 14.39 strike option, it expired worthless, and he received a net profit of $44,000 on that trade. Despite the initial trade being wrong, Roman made the right adjustments to minimize his losses. Ultimately, the stock favored his position and he made a profit. This is one of those things that you will notice from more experienced traders, is that they know when to adjust, they know when to take their losses, and they know how to position themselves appropriately during any trade. This is why you should be very careful with putting on some of these more complex trades, and you really need to understand how you're going to react, and paper trading is going to be a fantastic way of doing this. So post this, he's actually now moved to a bullish view, and he put on a bull call spread. A bull call spread is a little bit more complicated than a long call. So what you're doing with this trade is you're buying it in the money call and you're selling it out the money call. You run this when you're bullish, and what you want is you want the stock to expire somewhere between your two strikes. The long call, the first leg, that is the buying the in the money call, serves as your protection. However, your sold out of the money call creates a cap on the amount of profit that you can make on this trade. The good thing about this trade is that volatility is generally not going to impact you. And this is very good, again, for beginning traders. So before you're starting to get into your strangles and straddles, and in particular the sold versions of those trades, a bull call spread is the next step that you can take from a long call. What Roman decided to do, however, is he decided to modify it. So he bought more calls than he sold, which makes this a much more complicated trade. And let's have a look in a bit more detail as to what it looks like. The risk reward with a bull call spread is the maximum profit you're going to make is the cost of the spread, and the maximum loss you're going to make is the cost of the spread. So you're limiting your downside, you're limiting your upside, and what you're looking for is a sweet spot of what you think is a rational movement in the market. So in this case, if you spend 20 grand on a trade, the maximum you're going to make is 20 grand, the maximum you're going to lose is 20 grand. With the modification, however, what he's done is he's created the maximum profit to be theoretically unlimited. He buys 1,500 in the money calls and he sells 1,500 out of the money calls. However, with the modification, he buys another 500 in the money calls to give him that unlimited upside. Overall, this trade cost him $57,000 and gave him control of $750,000 worth of stock. So again, let's have a look at the chart of Sims. This is where he was trying to trade around having that consolidate, and he buys his 1439 call and he sells his 1538 call. So his sweet spot is now in this light blue line. Because of the modification, however, he's got an extra 500 calls that are going to profit if it goes above 1538. And what the stock does, it keeps within that light blue range to a T up until 2 days before expiry. So in this trade, in the second last day, where that candle shot up from 1520 to 16, the net effect was that 500 lots that he added, that extra 500 lots that he added, was the one that made him the most amount of profit on that trade. On expiry date, the stock settled at 16.09 and he profited $1.19 on each of the 2,000 lots, and he lost 71 cents on the 1,500 lots of the sold calls. Net profit he returned on that was $57,000. As with Andrew, Roman's returns and trading style would not be possible with equities alone. In the best case scenario, if Roman bought SGM, which wasn't his initial view, but if he bought Sims on the first day of the game and sold on the last, he would return less than $10,000. So today we've looked at 4 different strategies. We've looked at a long call, which was Andrew's first 2 trades over West Farmers and BlueScope. We've looked at the synthetic long stock, which is what he's paired to give himself a leveraged long stock position. We looked at a short strangle, which is one of Roman's trades. And we've looked at a bull call spread just before. Now I'm going to show you one more simple option strategy that you should consider using in your share trading today. If you don't know what a buy limit order is, It's in order to purchase a security at or below a specified price, allowing traders and investors to specify the price that they're willing to pay for a share. Let's make it a bit simpler. So let's say we're looking at Telstra, and this is data coming from the 10th of January. Let's say Telstra's trading $3.71. What you want to do is, if the stock drops to $3.50, you could enter a limit order. So what that means is, instead of buying at $3.71, you will say, I will buy Telstra only if it drops to $3.50, which is there. One alternative to this is a cash secured put. What you can do is, by putting a cash secured put on, you can get paid every day that your limit order does not get filled. Let's have a look at how. Let's assume you want to buy $50,000 worth of Telstra at $3.50. That means you're going to put on a buy. If you were buying on limit, you would buy 14,285 units at $3.50. Every options contract is worth 100 shares. So options alternative would be 143 contracts. 14,285 divided by 100. To price up an option, you will need an options calculator, such as a live calculator that you can find in our platform. Okay, so let's price up an option for a sold put that expires in 77 days. So I've just entered minus 143 to demonstrate selling 143 lots at $3.50, and I've picked March as my expiry. For this trade, I will receive $715, and I will need to pay $2.8 thousand worth of margin. Overall, in your derivatives account, you would need to fund $2.2 thousand. You will receive the margin back on the day that it gets exercised. One thing to keep in mind is the Americans versus the Europeans. The A in this case means that the style of this option is an American. There's a bit of a differentiation. An American, you can exercise, or it can be exercised any time before expiry. A European will only be exercised on expiry date. If the price falls below $3.50, you will own 14,300 units of TLS. However, you will receive $715 for the sold put. The best thing about this is you've actually improved your entry by 1.43% on your order value, and we just did a March, which was 77 days. If the price doesn't fall below $3.50, you will receive $715, and you can do it again and again and again until you get filled. That works out to be roughly between 5 to 7% annual return of the order value on an order that may not even get filled. So if you're not doing this today, you are not maximizing your profit. One thing to note, and this is where we get down to the rules. If Telstra goes to $3.50 and you don't want the stock, you have to close down your position and you will lose money on this trade. Timing is important and the cost of volatility is important. 2 tips to make this trade work without complications. Make sure you have the cash to buy the stock. If you don't have the cash, it's not a cash secured put, it becomes a naked put. And a naked put has unlimited downside risk. So if you're selling $3.50 puts on Telstra and Telstra goes bankrupt tomorrow, you will owe that stock to someone at $3.50. Make sure you want the stock. Don't do this over stock that isn't quality. If you don't believe in the story, or if you don't want to buy the stock, don't put this trade on. Okay, well, let's have a look at some next steps. I'm going to tell you about the next free webinars that we have. I'm going to tell you about our exclusive options platform offer. Then we're briefly going to talk about the next options game, and then we'll get into Q&A. Okay, so the next free webinars. The first one I'm going to be doing at the end of this month. We'll be getting started with options in just 60 minutes. We will talk about the cash secured put in a little bit more detail. If you weren't completely clear on it, we'll go into the ins and outs of that trade. We're going to talk about the covered call in a lot more detail and how you can use that in your portfolio today. We'll look at how you can trade synthetic option strategies, which will simulate your share portfolio so you can get a little bit more leverage in your trades. Quoting and pricing options. We'll also talk about the Greeks. So 2 sessions, the 30th of January at 12 p.m. Or the 31st of January at 8 p.m., whichever one works better for you. So I'll give you a second to sign up to that. That is on the right hand side. You should see a pop-up for that. Okay, the next one I'm doing is an intermediate guide to options, how to become a consistent trader using options in just 60 minutes. We're going to go into a little bit more detail with these ones. We're going to talk about spreads. I'll give you a crash course on margining and how to help you manage it. I'll give you an introduction to straddles and strangles. So this is the Roman trades that we looked at today, and I will explain to you how to get the edge in options with our platform. Again, 2 sessions. These ones are in the middle of February, the 13th of February and the 14th of February. Again, 12 p.m. and 8 p.m. depending on what works better for you. And again, I'll give you a second to sign up for that. Okay, well, let's talk about the implied volatility platform. Implied volatility is a joint venture between TradeFloor and TradeOn. We bring together our platform and TradeOn's online execution into one single home called impliedvolatility.com.au. So you can trade with the same platform that the professionals use and the one that you're used to playing with in the options game. You can build, trade, and execute TMCs straight through the platform for those of you that are doing spreads. You get fat finger protection, which you won't find in any other platform. It helps protect you from very costly mistakes and always provides you with a market maker price guide, which means that you will never have to execute into a market with no bid or offer ever again. And you have no limits on the strategies you can trade like some of the other brokers have. Plus, you will get the only real-time options calculator in Australia. There are 2 pricing tiers for the platform. The first tier is a trader, which gives you live data and all of the features that you're used to on the options game for $69 per month, including live data royalties. Now, if you trade over 7 times in a month, you will get that platform for free. The next tier is exactly the same as what you're used to with a trader, but you get the advanced charting and priority support. That is $149 per month, and again, you get this for free if you trade 15 times in a month. TradeOn is an online brokerage house that's partnered with some of the largest organizations in the world to bring you one of the most stable and safe brokers for you to execute through. It's powered by Phillip Capital, which will sponsor your HIN. It does the trading and execution on behalf of TradeOn. Phillip Capital is one of the largest brokers in the world and has a very strong presence in the Asian region. Your cash sits with Macquarie in a CMT account. You may already have this, so you would be able to port this over. Alternatively, just apply for a new one and that'll open up as you open up your account. The clearing and settlement is facilitated by Pershing, which is one of the largest clearers in the world. It's a fully owned subsidiary of BNY Mellon and has trillions of dollars under management. In terms of the rates, the equities start from $19.95, so it's one of the cheaper rates going around for equities, although we don't really specialize in that area, and options are $34.95 or 0.3%. However, for anybody that signs up today for a TradeOn brokerage account, you will receive options for just $24.95 for the first 12 months. That's 30% less than all the major brokers, and this will go a long way towards you trading profitably. Even if you don't intend to trade for the next few months, as you are learning options, this is a great offer to jump on. Now, I used to trade over 150 times a day, and one thing I can tell you with options is that every dollar you save on commissions helps dramatically. On top of that, you will receive the TradeFloor platform for free for an extra month. So when you sign up to Implied Volatility, you'll receive it for free for the first month. No credit cards required, nothing like that. If you sign up today, you will receive an extra month of the platform. Also, you will get access to a bunch of great webcasts like this one, which we'll continue doing, and you will also get a weekly Q&A session. Again, the registration page is impliedvolatility.com.au. Don't miss out on this great offer. Okay, the next options game is going to be roughly around about March. We'll send the details closer to the date. If you're not receiving emails from us, please go to your spam box and mark us as a safe sender. You'll find that on the bottom of any email, so that way you can definitely know when the next game is on. Alrighty, well, let's jump into the Q&A.